Hello, everybody. I was waiting patiently, but watching great presentations. So well done, Mark and Finola at RaaS for putting this together. So thank you for inviting us. So next half an hour, we're going to have a little update, chat about Pureprofile. So for those of you who don't know, really simply, we're a market research company. So what does that mean? We basically help customers, and a customer could be the government, a university, a brand, a consumer brand, or a B2B brand, understand their consumers, their competitors, the market, their voters, whatever it may well be. And we do that through either analysis of going out and asking questions to people online, or the analysis of raw data that we have available and we bring into the business. And basically every product we've just had Carly on this, Chris talked about cars, etc. Cars go through market research before they are released. The advertising goes through market research before you see it. All the packaging, everything that you touch and feel has had some level of market research. So it's sort of like the Intel inside. Market research, unless you're in the space, touches every part of our lives. What sums that up? It's $130 billion US industry around the world. 55% of that comes out of the US market. About the UK market is about 15% or 9%. Australia down at 2% where we are. So it's a huge market where today we have low market share. Outside of Australia, we're number one in Australia. And what we've been doing for the last 3 years, when we talk about the numbers, is exporting our knowledge, our expertise into the rest of the world. And actually today, we now have operations in 13 countries. So we've expanded greatly. It's a slide that comes up, and on the right-hand side, everybody's talking about AI, and it's been interesting on, again, the presentations this morning. AI isn't quite relevant for their businesses, and so we haven't heard a lot of conversation about it. It's very relevant for ours. And really, it's three key areas. We've got increased partner revenue. All of these AI companies that we see setting up and we hear are setting up, they need data. They need data so that they can train their AI engines, so that they can validate what they're about to say to make sure it's right. And then thirdly, the AI engines that we see out there at the moment, ChatGPT or Bard or whatever that we may use as consumers, they tell us what people are doing, but they don't tell us why. And until you deep dive into companies such as Pureprofile and our data, you're not able to answer the why question. So somebody can understand this is the population in Australia that's buying electric vehicles, but actually I don't know why. What's driving that? Is it people caring about the planet? Is it actually people that are looking at cost? Is it that I get tax breaks, etc., etc.? So the why, that becomes really important in the AI space. So that's number one, whole new raft of clients we've got. Number two, it enables us to increase revenue because actually we can innovate and launch new solutions to our clients faster. So we've got a number of new AI solutions that are in development at the moment for our clients, which increases revenue streams. And then thirdly, it's about growing efficiency, increasing efficiency. So we have, again, a number of AI solutions that we've rolled out during the year, or we are in development at the moment, that allow us to be much more efficient as a business. So the benefit to the clients, we can be faster, we can lower the cost. To us, as we grow, as we scale up the business even further, we don't need to keep adding people into our business. So they're the three key areas where AI is very, very exciting for us. For those of you who don't know the history of Pureprofile, we're actually a 23-year-old company, 24 years coming up. We first floated in 2016. In 2020, when I came on board, we did a company restructure, got rid of an amount of debt that the company had, and really focused on being a data and insights company, and pivoted from previously being an advertising company. We've then spent 20 to 23 actually growing our international markets, focusing on adding global team expansion. So that's both people globally and people who understand running a global insights business. We've re-engineered our core technology. We've got a key solution called Audience Builder that brings in more data points. So growing that as a USP, increased efficiency. In actual fact, for the best part of the last 3 years, we've actually been cash flow positive. So it's not been a problem for us for raising money to keep the lights on, not anything that we need to do. And then finally, really developing that total global organization, enhancing both shareholders and employees. And so we're at the end of that second 3-year journey, and we finished that second 3-year journey, and we go into the next 3-year journey, which is about us accelerating our global growth. So we've done that core development, so increasing our revenues around the world, and we'll talk about those in a few slides, working with new types of clients, direct with end clients. We've done a lot of work historically with research agencies and advertising agencies. It's actually having solutions to work directly with clients, building an integrated suite of products that people can come to, select, move on, use, rent, maybe buy, and move on to a different solution instead of having 800 clients who use siloed products. As we say, continuing that global growth, continue utilizing AI, growing our data points through Audience Builder and other ways. And then finally, once the market cap allows, looking at acquisition opportunities, looking at smaller versions of Pureprofile that give us an immediate step change in a certain market. So that's what we're really looking at further this year and the next 2 years. Again, in picture form, back in 2020, we had access to about 10 million data points, or panelists as we know them. It was a very manual process. So getting a client access to our platform, we've got over 100 people in India and the Philippines, all conducting surveys, analyzing data, etc., for clients. That then moved on to the end of 23. We've over doubled the access that we have to panelists. The key difference now is we've added in those yellow boxes what are known as APIs. In other words, direct access for clients to access our platform without needing people. So that is a higher speed, can be a lower cost, greater efficiency for us. And we brought in a new product called Audience Intelligence, which allows us to bring in other data sources. And that data source happens to be transactional data in Australia. But the key thing is it's a stepping stone to other data sources. And then we move forward and we look at the end of 25. Well, we've then got access to 50 million people. AI enables you to deliver something called synthetic data, which is based on that training data, as I talked about earlier. We've got on the left-hand side AI solutions being used for clients. We've got us moving into new spaces such as qualitative industry from just quantitative that we're in today. And then the bottom one is having direct client ways that clients can work with us, and having client-facing solutions. And a couple of examples could be ad effectiveness, brand tracking. So becoming much more left-hand side client-focused, much more new revenue streams, and on the right-hand side being much more efficient as a business. So if we look at our half one results, so these are all like for like, half one 24 versus half one 23. I talked about the global expansion. So the rest of the world, we grew 22% half year on half year. In total, we had an 8% revenue growth. We had a 6% EBITDA growth, but in actual fact, it was an underlying 21% EBITDA growth, because another change that we made this year was previously to attract great talent that we have around the world and the senior talent growing this business. We've paid bonuses in shares, so it's been outside of EBITDA, and we're in a position to be able to pay STI and LTI, or STI, sorry, I should say STI bonuses in cash, which actually means we're now non-dilutive to shareholders. And that slide adjustment is underlyingly with 21% growth, which again, excuse me, which again talks to that margin expansion that we've seen. So if we hadn't been paying the STI in cash, we would have seen revenue growing 8%, but EBITDA growing 21%. So that's been a focus for us as a business. We got 795 clients around the world, so really nice mix of clients in geographies, no issues and over reliance in any one market and any one client. And then the bottom one, where we see that efficiency come from, our platform growth has more than doubled in half year over half year. So we've got 104% growth in platform in 24 versus 23, which is great to see. And again, excuse me, I have a frog in my throat, which is again delivering that EBITDA expansion that we see, giving clients direct access to our core data and our audiences, as well as growing audience builder partners that we have done. So a really nice set of numbers. We can also see here ANZ was flat half year over half year. There clearly the markets, if we look at the inflation figures and we look at December, which had the greatest drop in consumer expenditure, the Australian market has slowed. Again, as an organisation, we've got other revenue streams coming on. We're growing that, our core one of data delivery as well, and we still continue to grow as a business. And now actually globally, non-Australian business makes up over 42% of our business today. We're in the market leader. So great to see that expansion is paying off in the rest of the world. And even though there's a downturn in the Australian market, we're holding our own and holding that level. If we look at some charts, so Australia over the last four halves, we've seen 18% or 3-year CAGR growth. Rest of the world, 42% growth. Going into that, US market being 40 times bigger than the Australian market, UK being 11 times bigger than the Australian market. So leaning into that and investing into that. Our platform growth, 114% over 3 years, and our EBITDA, 23% growth over the 3 years. So those are the key metrics, some of the key metrics we look at. We've also reaffirmed the guidance at the end of the half year, the guidance that we gave at our AGM, which is revenue of 46 to 51 million for this year, and EBITDA of 7 to 9%, including the change in the STIs coming out of EBITDA now. And then if we look at what have been the achievements in the first half, well, again, investing around the world, seeing that 22% in rest of the world growth, fantastic. We opened an Indonesian office in this year. We've got a couple of salespeople now in Indonesia, supported out of our Singapore office. We also announced in January that we'd opened Germany and Spain and Portugal offices. So excited about that, to see the EMEA growth. And actually in the half, one of our US clients is now a top 5 client. So again, that identifies, or that shows the size of the US market, that a new client can come in and immediately sit in our top 5. So very excited about that. Platform, we had a couple of new partners delivering us data points and people who can do surveys. In Australia was Shopback, and in the UK, a company called Prograd, focusing on younger audiences. We expanded the client base using our direct API automation. So that again is avoiding going to any people, and as I said earlier, faster, and it's more efficient for us, and that's helped more than double our platform revenue. And then on technology side, we've seen some audience builder enhancements, direct access clients, and actually way back now, almost a year ago, we created a specific AI team in our business, and both identifying opportunities, solutions to problems and opportunities that we can solve using AI, which is now feeding through certain developments and enhancements that we're doing. What are the key priorities for the rest of this half? Well, as I talked about, AI internal processes, where can that be used to enhance those? Client-facing solutions to deliver additional revenue streams. Separately to that, general tech innovation, as our CTO says, let's not just talk about AI. We actually are solving problems and delivering solutions to opportunities, which might be other solutions other than AI. AI enables you to quickly prototype things which you couldn't have done before, so that's quite nice. But again, technical innovation, delivering new client-facing solutions, as opposed to the last 3 years that we've spent enhancing our core technology. Audience builder, increasing our panelist and data points around the world, and we've got some ones that we're talking to at the moment. Adding new clients with that team growth to enable client revenue growth. UK and US, again, 64% of the global market of that $130 billion market comes from the UK and US. We've now got nearly 20 people in the UK. So it's about delivering and growing into that space. And then also commercial partnerships. So we're quite unique with that 13-country footprint in the data and insight space. There are many solutions out there where they only operate in one market, and actually they're coming to us now. We're looking at can Pureprofile offer their solutions in various markets to our existing clients. So those commercial partnerships are coming through now, where we don't have to build something, but we can cross-sell to our near 800 clients. So in summary, we're absolutely an international business. As 3 years ago, we're in 5 countries, today in 13 countries. It grows at more than double the rate of the ANZ markets. Again, 3 or so years ago, about 70% of our business came from Australia. It's now around about 52%. So that's been an absolute focus for us as a business. We've got, again, another record set of numbers from Pureprofile. It's a record half-yearly revenue and record EBITDA numbers achieved in half 124. Record platform revenue for 24. We've got really loyal and satisfied employees and customers around the world. And we carry on to focus on the data and the global data and insights opportunities for us as a business. So we've done, and we continue to do everything that we've said we would set out to do 3 years ago. So that is a quick overview of where Pureprofile sits today, Mark.
Thanks, Martin. And yeah, just finally, I'll just mention I have uploaded the RaaS research latest note for Pureprofile. It's in the chat there if anybody wants to download it. Martin, I must just kick off the questions here. In terms of the investment you're making in building APIs, AI on kind of both sides of the diagram, as you were talking about, that seems like quite a capex investment that is going into the business. Moving forward, should that cost start to decline? Like, are we seeing kind of peak capex at this point in the cycle to take advantage of the AI kind of opportunities on both sides of the coin, or are we going to see a kind of a new focus on technology investment within Pureprofile, and it's going to be now just kind of start of a new phase?
Yeah, really good question, and it's sort of a combination of that. So we're a technology-led company, but not actually a technology company. So we're technology-led. So the way clients access our data is through technology. So really, to your last point, it's a shift of our capex expenditure. So no, we don't expect our capex to grow beyond what you've seen in our numbers over the last couple of years. So we're seeing it pretty consistent with that outside of salary reviews, etc., as occur. But it's really a shift now. It's a shift from, again, as I've said, the last couple of years, that 2 million or so a year in capex that we've been spending on development work has been behind the scenes, unseen internal efficiencies and internal upgrades. And now what you're starting to see is that majority of that 2 million being spent on client innovation. And we needed to get rid of that technical debt that existed within Pureprofile over the last few years before we could move to innovation. And we've used a phrase internally, which is, Pureprofile has been very similar to changing the wheels on a car while the car's still moving. So whilst we've known we've had this technical debt, we've seen this revenue growth and EBITDA growth in spite of that. And again, sort of 3 years or so ago, I think our revenues were about 22 million Australian. And now as we said, we've given guidance up to top end of 51 million. So we've had that stellar growth whilst we've been upgrading all of our internal systems. Now, with the same money, we move to innovation.
Okay. Question from the audience, capital allocation one in terms of, looking at acquisitions as opposed to, maybe paying down debt that's still within the business. Just maybe give us a sense of, where you are and the board are at in terms of, capital allocation decisions coming into, 2024 and this worldwide expansion and, maybe buying up some of these smaller players to give you that little foothold or bowhold in a particular market or a particular region globally.
Yeah, look, there's a lot to unpack in that. I mean, firstly, we have approximately $3 million of debt, which Melinda Shepherd, our CFO, spent good part of 8 months moving from a debt fund to CBA. So I think well done to Mel and the team for doing that. But there are very few microcaps today that have the trust of a big four bank that will take on the debt. So that again gives a great endorsement to how far Pureprofile has come in 3 years that we've now got that with CBA. Part of that is interest and capital repayment. So we'll see that debt naturally come down each quarter now as we make some payments back to CBA, and we're in a position to do that. We don't see the debt as the $3 million as an issue, and don't see the need to use funds to pay that down is the first point. I think one of your questions. I don't think it would. Well, no, I know it won't dramatically change Pureprofile's standing with shareholders, current and future, if we pay down that $3 million debt. We feel that what's more important as a business, which actually I didn't mention, should have done, is we're heading towards true NPAT profitability. So a key thing for us as the business as I said, we've been cash flow positive for 3 years or so now. The key next milestone for us that we've talked about for about 12 months or so is being true NPAT profitable. And so we see that as being important to our business and to our standing. And if we can continue to grow 15 to 20% at the revenue line, then we're still a growth company. But then additionally, we can be NPAT positive. And once again, there are very few companies that are growth companies in exciting growth spaces. We are truly international, who are also NPAT positive. So we see that as an important milestone. Regarding acquisitions, We can continue to grow organically, as we have done. And if you say, all right, we've doubled in size in the last 3 years, then again, current and future shareholders could say, well, we organically, the business, you've done the hard first 3 years of sort of getting scale, of changing your technology around, then the next 3 years we should see that continued growth level. So, getting upwards of 80 million based on the last 3 years organically. So if you can do that, then again, current shareholders saying, well, why go out and make an acquisition? And so we've got that as in the back of our mind. We've also got, our market cap today is $30 million. So I'm trading at $30 million. I've given guidance up to 51 million. I'm cash flow positive. I'm growing EBITDA underlying at 22%, but my market cap has come down from where it was about a year and a bit ago of nearly 90 million to 30 million. And when it was at 90 million, I was a company that was doing sub $40 million of revenue, about a 7% EBITDA margin, and about 2 million off of NPAT positive. So I've gone from 90 million down to 30 million. Meantime, private opportunities haven't dropped down to a third of their value. So everything that we look at today is actually more expensive. It's more expensive. It's 3 times more expensive than it was 18 months ago. So the other thing that we've got very much in our mind is, this is shareholders' money. I'm a significant shareholder in the business as well. So we need to look at what's the dilution of actually purchasing somebody today that's going to cost us 3 times as much. And realistically, are we just buying revenue? Are we buying a bit of profit? I would rather it becomes easier when the market cap goes up further, and more in line with where private companies' valuations are today versus ourselves. So today it needs to be a pretty surefire acquisition, and all of those, apart from due diligence, obviously take integration and change management, etc., etc. So there's very little which is surefire, and so that more pushes us towards that, or continuing on the organic growth and the organic story that we have.
And then finally, maybe if we can just touch on the ANZ business, which was flat, as you kind of pointed out. In terms of, getting growth back into the Australian business, is that a function of, trying to get some decent client wins? You referenced the new US client coming in, and it's already dropping straight into a top 10 client for Pureprofile as a business overall. Is that kind of what's needed in the Australian business to get it going? Is, just one or two of these decent client wins, whether that's, an expansion of work with a current client, or, somebody you've worked with overseas who's got a presence in Australia, to, start working with you in this market? Or has Pureprofile kind of reached its natural size in the Australian market, and we should kind of temper our expectations and expect it to, kind of follow market, the general market theme of, we're in a growth phase, we're in a slightly downward trend, and with a bit of price fluctuations thrown in there?
A very good point. Now, we in our half year or our quarterly release, our Q2 release, we actually touched on this. So it actually is down to ANZ had a poor October, and then a catch up in November, and December was back to growth numbers. But we saw growth in Q1, growth in December and November, small growth, but then actually it was a downturn in October. It was just a downturn in October that we saw that affected H1. So in the other 5 months, we actually had positive growth in ANZ. Look, we are the market leader in ANZ, so everybody guns for us. And if there is any downturn in the economy, again with a market leader, so you get affected by that. But we saw it as one particular month. That said, you actually look at that and say, okay, what do we need to do differently as a business as well? So it's making sure the sales team gets down to basics with clients again. We're sharpening pencils on pricing. You talked about pricing, not taking any clients for granted, not that we do anyway, but making sure that we're front and center. The question is not around the service team that we have, the account managers that we have, the quality of the data that we have. So the only other lever can be, is it looking at pricing that clients are trying anybody else if they are doing that? But really, it was about that downturn that we saw in October. So again, we expect ANZ to come back to growth again as it did in the other 5 months of the first half.
Okay. Martin, thanks very much for
Sorry, Mark, just to add,
Sorry.
but historically, we've seen double growth internationally, which is what we focused on.
Yeah, and I mean that is where the predominant amount of growth is going to come from, just on the two market opportunities. Martin, we will leave it there. We're gone just slightly over time, and I don't want to take up any more of your time because since you were listening into some of our other prezos. But thanks everyone for joining us this morning. It was great to get 4 RaaS companies here and be able to share their research as part of the presentation. So hopefully you've had a chance to download those in the chat as we've been working our way through the presentations. And I'd like to wish everybody a good rest of their Wednesday, and we'll leave it there. Thank you.